Why Americans are falling behind on car loans. In recent years, there has been growing concern over the increasing number of Americans falling behind on their car loan payments. This trend has raised questions about the stability of the auto loan market and its potential impact on both consumers and the broader economy. Let's delve into the details of why this is happening. Number 7. Rising debt levels. The increase in delinquencies on car loans can be closely tied to the escalating levels of consumer debt among Americans. Over recent years, stagnant wages coupled with a relentless rise in the cost of living have placed significant financial strain on households across the nation. As individuals grapple with the necessity of essential purchases such as vehicles, many have turned to borrowing as a means of financing these expenditures. However, this reliance on debt to bridge the gap between income and expenses has created a precarious financial situation for numerous households. With debt levels reaching new heights, individuals find themselves in a precarious balancing act, struggling to manage their monthly obligations amidst mounting financial pressure. As they allocate more of their income towards servicing existing debts, there is often little room left to absorb unexpected expenses or fluctuations in income. Consequently, even minor disruptions to their financial stability, such as an unexpected medical bill or a temporary reduction in working hours, can have cascading effects, making it increasingly challenging to keep up with loan payments. In this context, the burden of consumer debt acts as a weight dragging down the financial well-being of many Americans, contributing significantly to the rise in delinquencies on car loans. Number 6. Subprime lending. The prevalence of subprime lending in the auto loan industry represents another significant contributing factor to the increase in delinquencies on car loans. Subprime loans serve as a lifeline for individuals with poor credit histories or low credit scores, offering them access to credit that might otherwise be unattainable. However, this access comes at a cost. Subprime loans typically carry higher interest rates and less favorable terms compared to prime loans, reflecting the increased risk associated with lending to borrowers with less than stellar credit profiles. For borrowers already facing financial challenges such as limited income or unstable employment, the burden of higher interest rates and less favorable terms can exacerbate their financial strain. These borrowers may find themselves caught in a cycle of debt, where the high cost of servicing their subprime auto loan leaves little room in their budget for other essential expenses. As a result, they may struggle to make timely payments on their car loan, especially if they encounter unexpected financial difficulties such as medical emergencies or job loss. Number 5. Longer loan terms. In recent years, the auto industry has witnessed a notable trend towards longer loan terms, a phenomenon that has significant implications for both borrowers and the overall stability of the market. While longer loan terms have the immediate effect of reducing monthly payments, thereby increasing the affordability of vehicles for many consumers, they also introduce several potential risks. Firstly, extending the duration of auto loans means that borrowers remain in debt for a prolonged period. While this may seem advantageous in the short term by providing relief on monthly budgets, it also exposes borrowers to a higher risk of delinquency over the extended repayment period. As the loan term lengthens, borrowers are more susceptible to encountering financial hardships, such as job loss or unexpected expenses, which can impede their ability to make timely payments. Consequently, the likelihood of delinquency and default increases, particularly among borrowers with limited financial resilience. Moreover, the elongation of loan terms can exacerbate another concerning issue: negative equity, also known as being underwater on the loan. Negative equity occurs when the outstanding balance on the auto loan exceeds the vehicle's actual value. With longer loan terms, borrowers may find themselves in a precarious financial position, owing more on their cars than they are worth. This situation not only erodes the borrower's financial stability, but also poses challenges in the event of unexpected events, such as vehicle damage or the need for replacement. Number 4. Rising interest rates. The upward trend in interest rates on auto loans represents a notable challenge for borrowers seeking to finance their vehicle purchases. As interest rates climb, the cost of borrowing increases, leading to higher overall expenses for borrowers. This uptick in borrowing costs translates directly into higher monthly payments, placing an additional strain on borrowers' budgets and financial resources. For many consumers, a vehicle is a necessity rather than a luxury, essential for commuting to work, transporting family members, and carrying out daily activities. Consequently, the affordability of auto loans plays a critical role in determining the accessibility of vehicles to a wide swath of the population. However, as interest rates rise, the affordability of borrowing diminishes, making it more challenging for individuals to secure financing for their vehicle purchases. Higher interest rates not only affect the initial affordability of auto loans, but also have a compounding effect on the total cost of borrowing over the life of the loan. Even a slight increase in interest rates can result in significantly higher total interest expenses over the repayment period, adding to the financial burden borne by borrowers. This increased cost of borrowing can divert resources away from other essential expenses such as housing, healthcare, and education, further straining household budgets and potentially exacerbating financial hardship. Number 3. Economic uncertainty. The economic uncertainty triggered by events like the COVID-19 pandemic has had profound implications for borrowers in the auto loan market, exacerbating the risk of delinquencies and defaults on car loans. As businesses shuttered, unemployment surged, and economic activity ground to a halt, millions of individuals faced unprecedented financial hardships, making it increasingly challenging to meet their financial obligations, including car loan payments. Job loss and reduced hours emerged as primary drivers of financial distress for many households. The sudden loss of employment or a significant reduction in income deprived individuals of the financial resources needed to cover essential expenses, such as housing, utilities, and loan payments. In the absence of a steady income stream, prioritizing debt obligations like car loans became a daunting task for many borrowers, leading to missed payments and eventual default. Furthermore, the ripple effects of widespread economic uncertainty extended beyond job losses to encompass other financial hardships, such as medical emergencies, childcare expenses, and disruptions to household finances. These unforeseen challenges strained borrowers' ability to manage their debt effectively, leaving them vulnerable to default and repossession. The unprecedented nature of the COVID-19 pandemic compounded the difficulties faced by borrowers and lenders alike. With uncertainty prevailing over the duration and severity of the crisis, forecasting future income and expenditure became inherently uncertain, complicating efforts to develop effective strategies for managing delinquencies and mitigating losses. Number 2. Lack of financial literacy. The pervasive lack of basic financial literacy skills among many Americans represents a significant barrier to sound financial decision-making, particularly in the realm of borrowing and lending. Without a solid grasp of fundamental financial concepts such as interest rates, loan terms, and budgeting, individuals may find themselves ill-equipped to navigate the complexities of the borrowing process effectively. At its core, financial literacy encompasses the knowledge and skills necessary to manage personal finances effectively, including understanding how to borrow responsibly and make informed decisions about borrowing and lending. However, for many Americans, financial literacy remains a glaring gap in their education and understanding. As a result, individuals may unwittingly take on more debt than they can afford, succumbing to the allure of easy credit without fully comprehending the long-term implications of their borrowing decisions. Without a clear understanding of interest rates, individuals may underestimate the true cost of borrowing, failing to recognize the impact of even modest differences in interest rates on the total amount repaid over the life of a loan. Similarly, a lack of familiarity with loan terms and conditions can leave borrowers vulnerable to hidden fees, penalties, and other unfavorable terms that may exacerbate their financial burden. Number 1. Impact of technology. The proliferation of online lending platforms and digital financing options has undoubtedly revolutionized the process of obtaining auto loans, offering unprecedented convenience and accessibility to borrowers. With just a few clicks, individuals can compare loan offers, submit applications, and secure financing without ever leaving the comfort of their homes. However, while this increased accessibility holds significant potential benefits, it also introduces new challenges, particularly in terms of borrower understanding and transparency. One of the primary concerns associated with online lending platforms is the potential for borrowers to enter into loan agreements without fully understanding the terms and conditions. The convenience of online applications and instant approvals may incentivize borrowers to prioritize speed and ease of access over careful consideration of the terms of the loan. Consequently, some individuals may overlook important details such as interest rates, loan fees, repayment schedules, and penalties for default. Moreover, the digital nature of online lending platforms may further obscure the terms of the loan, making it difficult for borrowers to discern the true cost of borrowing and the potential consequences of default. Unlike traditional face-to-face interactions with lenders, where borrowers have the opportunity to ask questions and seek clarification, online lending platforms may offer limited opportunities for meaningful engagement and dialogue. Stay informed and empowered. Subscribe for more insights on navigating the complexities of borrowing and lending in the digital age.